and welcome to Economy and Markets TV, where we have conversations with a purpose. I'm your host, Dave Okenquist, Senior Research Analyst here at Dent. Joining me to take you around the world of economic and financial news and covering each topic in under 2 minutes is the editor of Boom and Bust, Mr. Rodney Johnson. Rodney, how are you?
I'm well, getting out from under all the rain here in the Houston area, but I'm doing well.
Yeah, I saw on the news it looks like street flooding. Well, that's more of a common thing with you now. I read your latest piece of how you're a truck family, and it comes in handy in your your rainy conditions where you are. Here in Tampa, you live in a hot and humid climate where when you're out at night and it's 75 degrees and you start getting goosebumps.
Exactly, right? You're acclimated.
Rodney, let's dive into the news of the week. The big thing, of course, was the Fed. The Fed cut rates by 0.25%, putting rates, the federal funds rate, between 1.75 and 2%. Yep. Rodney, the board was a little split on this decision. It was 7-3, as you note in the copy today. The markets didn't really like it. The president certainly didn't really like it. So, question for you is, did you like it? Was this the right move?
I don't like it, but I like it for completely different reasons. The president wants a much bigger cut. He wants to spur borrowing, spur lending, drive the economy, lower the discount rate so asset prices fly, blah, blah, blah. Bullard, who's on the board, said the same thing. He wanted a cut of 50 basis points. The two other dissenters said that they didn't want a cut. They thought we were in a good place. I look at it and think they're kind of going the wrong direction. Not that I would necessarily raise rates, but I certainly wouldn't lower them. The economy's bumping along like it has been for a decade, growing between 1.5% and 2.5%. And so there wasn't a reason for this that's domestic. And so you're looking at the U.S. economy, and it's not like we needed the Fed to cut rates to do anything. I look at it as more of a defensive move. It's something I talk about in the Boom and Bust copy that's coming out for October, where this is about currency. And we're getting in lockstep with this currency game with other nations and, of course, the trading bloc of the EU, where we don't want their currency to be cheaper than ours because everybody's doing the dance of exports. And that's kind of the name of the game.
So it's all about just basically defending the dollar here, especially in light of what we're trying to do in trade as well. Is that making things more difficult for the Fed?
Well, it's actually a reverse defense, right? You don't want to be strong. That's the president's point, and that's some other people's point, is you have the European Central Bank, you have the Bank of Japan, you have certainly the People's Bank of China, who are trying to make their currency weaker, although the People's Bank of China is getting some help from the marketplace. But definitely the ECB and the Bank of Japan are trying to make their currencies weaker so their exports are more attractive on the world market. That means the dollar is stronger, our exports are not as attractive, and so the game is, don't let other people make your currency go up. Kind of a strange thing. It's where no one wants to be king of the hill. The reverse, right? No, you take it. I don't want it. You take it.
Well, otherwise we turn into the Swiss, right? And that would make international trade a lot more difficult, right?
Right. And remember back to 2015 when The Economist does this Big Mac index, which is a very silly but powerful view of how currencies are valued around the world. And it looks at what it takes to buy a Big Mac in dollars around the world. In the US, it might be $4.50. Well, in 2015 in Switzerland, it became the equivalent of $17 to buy a Big Mac because their currency, exactly, right? Their currency had exploded in value, and they tried to manage it down. They did a good job, but it's hard to do. Certainly hard to stay ahead of that.
Well, I think a Big Mac is a ripoff at $5, so I couldn't imagine. Well, not that I'd go to Switzerland to buy a Big Mac, but
$17 is quite a number, though.
Yeah. Rodney, we're a little long here, but it's an important follow-up to this. There's a little bit of maybe a liquidity crisis going on right now. And I want to just ask, what might the Fed be doing about that? What is this all about? Just if you could maybe talk about this briefly.
Yeah, and there's a piece of research we put out while I get into this a little bit more, but it's the repos where you pledge something to somebody you want to borrow. And so you want cash. You give them an asset, in this case, it's U.S. Treasury bonds, and you make a pledge to buy it back in a day or 3 or 7. And so it's a repurchase agreement, but they shorten it to repo. What's going on is there aren't enough dollars floating around right now for all the people that want to borrow them. I mean, real dollars in terms of in bank accounts. And so people are looking at this and going, wait a second, they're bidding up the price of what they'll buy back their asset at to get the dollars for a few days. And so I know it's kind of clunky, but you can think of it like a short-term version of a pawn shop. You know, you give them your rifle, you get cash, and you buy the rifle back in a couple of weeks or a couple of months. This is just a short version in the financial world. The problem is the pawn shop doesn't have enough dollars for everybody that wants to do this. And so people want the Federal Reserve to buy more bonds. And when the Federal Reserve buys bonds, they create money out of thin air. So they put more money into the general system. That's what this is all about. And so the reason this has come to a head is because the world uses dollars. As much as people talk about the dollars being dethroned and everybody's getting away from it, blah, 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 it's a bunch of hooey. It's not true. Yeah. The dollar is still a part of 89% of all currency transactions around the world. That number just came out from the Bank of International Settlements. And we have a much higher amount of trade than we did, 7, 8, 10 years ago. And so there's a greater demand for dollars in the short-term market, and there's just not enough. And so the Fed is trying to alleviate that by perhaps buying some more bonds, not to stimulate the economy, just to put more dollars into the system.
Now, if these short-term moves don't sort of fix this issue, does that mean we could be seeing, out of necessity, the Fed pumping more money into the economy in the form of QE?
It is QE, but it's not the same type that you think. It's not like they're going out and saying, hey, we really need the economy to go, so we're going to buy bonds with newly printed money so that interest rates come down so that people borrow more. It's really, hey, we're going to buy bonds, but they may buy just short bonds, right? Bonds that mature in a couple of months or, a year, so that they just literally get more money into the system. It's all about just making the pool of money around the world, US dollars around the world, bigger, so that short-term interest rate that people are paying to borrow those dollars comes down. It hit about 10% on Monday, which is a crazy number, but you got to remember that's an annualized number, and then they, cut it down to what it would be for just a day or two. Still 10%, but it's not a huge dollar amount.
Last thing on this, Rodney, was this spike at all indicative of, is it a warning sign? Last time I think we saw this was maybe 10 years ago, not the heels of the last crisis. Could this be any kind of a sign that there's trouble ahead, or is this sort of a temporary spike thing?
It's a temporary spike thing. It's about the Fed lowering its balance sheet by a trillion plus as it was trying to pare it down to pre-crisis levels, which isn't going to work.
Yeah.
Previously, in 2007, 2008, the liquidity crisis was that people were literally running out of money because you had bad actors out there that couldn't pay their bills. You had these mortgages defaulting, so money wasn't coming in to the people that had basically lent it out. They weren't getting their mortgage repayments. And so that created this cascade. That's not what this is about at all. This is really about very short-term borrowing to satisfy contracts where the liquidity pool that you can borrow from got small only because the trading got big. It's not a bad thing.
Gotcha. Well, we went way long on that, but I think this is important
right.
stuff for us to cover, especially if people do have questions about this. If they're seeing this on Wall Street or in the Wall Street Journal or on CNBC, and really, if you do look around, that nothing's really explained. So I appreciate you taking the time to do that, Rodney. Rodney, we also got news on housing. Housing starts were up 12%. We also saw a rise in completions, and we also had an existing home sales report up 1.3% in August. Also, for those sales, the price fell just a little bit, so that's good news for affordability. Also, there was a bounce back in sales. I believe you said it was the highest since February of 2019. What was the reason for this bounce back in sales, Rodney?
Well, everybody's looking at interest rates. So am I. I mean, I'm in the middle of a house transaction right now, selling mine, buying another. I was quoted 3.5% on a mortgage, and then I was quoted 3 3/8 on a 30-year fixed mortgage. That's pretty cheap.
Yeah.
And so when the interest rate comes down, of course, you can buy more house with the same payment. And so that's what this is about. As interest rates come down, you have a larger number of people at the margin that can afford to buy a home. And so I think that's exactly what we're seeing. We can't discount the fact that we do have unemployment, at multi-decade lows, and we are seeing wages come up some. So the affordability is kind of creeping up, meaning more people can afford because they have a little bit higher income. At the same time, interest rates came down. And so it's kind of a double positive there. How long will it last? I don't know. If rates remain low for, the next 6 months or year or whatever, it could give us something of a boost. But we will need more sales in terms of units. We'll need more inventory to come into the market, which is a good thing on the completions number. And we'll have to see wages continue to go up.
I've got more, I'm more of a follow-up guy today here because it just makes me think. The last crisis, the market was really out of whack in terms of supply, demand, all of that. And as I mentioned, as you've explained, in terms of what builders have been doing lately, is they're just building only the inventory that they are really sure they can sell. They don't want to be left with these developments that are going to be empty and have to be torn down. So is the real estate market really attuned to what's going on? In other words, can we really expect it to fluctuate all that much? I mean, they waited for wages to come up, and we're just going to be in this tight band of affordability and inventory. Because there's only so many houses that are going to be built, and there's only so many people that are going to be able to afford to buy them. So are we going to be locked into this, or am I just reading that wrong?
No, I think it's a fair question and probably a fair assessment. I mean, of course, Harry's view is that real estate's going to come down dramatically. It might, the economy rolls over, you might see that some, but boomers don't have to move. And so what we saw before in the crisis was people were buying 2, 3, 4 homes.
Right.
They were getting crazy loans to go out and do this. It was the availability of money to buy homes that made that thing go. We don't have that right now. People aren't, lending what were, ninja loans, no income, no job, no asset loans. People aren't doing the Alt-A loans and all the crazy things they were doing before at the same level. And so I don't think you have that same, rush of money chasing homes that you did before. Instead, you have what you said, which is you don't have as many homes on the market because builders are looking at it and going, I don't want to be stuck. Also, builders not putting out a bunch of low-end homes. And I don't mean cheap, I mean lower for affordability,
right?
Because frankly, they can't. The cost of land, cost of regulation, cost of labor, all of it has gone up. And so they have to build the higher priced homes to get their money out, which keeps the lower set in terms of first time home buyers out of the market. And that's unfortunate.
Excellent. Definitely something to keep an eye on. This definitely seems like a big change from what it used to be. Rodney, Amazon ordered 100,000 electric vans from startup Rivian. This is interesting. It's kind of this is a company you showed me. They've got a great looking concept truck and SUV. It's really sharp looking. The SUV kind of looks like a Land Rover and Jeep combination. Yep. Just beautiful looking, beautiful looking truck. I want one if you can't tell.
I think you're coveting their vehicle. I can see that.
Yeah. Well, anyway, Jeff Bezos has a 30% stake in this company where he invested $700 million. And so a good way of helping a business that you have a stake in is to become a customer of that business. But this is really interesting. Also, the concept of, I saw a concept of this electric van. It basically looks like those dark blue Prime vans that you see going in every other neighborhood 10 times a day. So expect more of those on the road and electric. They last thing before I turn this over to you, the company wants to be carbon neutral. I don't really know what that means, but they want to do that by 2040. So that's a part of the plan. What do you think of this? And this seems like this would definitely help the future of Rivian get off the ground, right?
Oh, it certainly helps Rivian, because you have a built-in client for 100,000 units. I mean, remember, it took Tesla quite a long time to sell 100,000 units.
Right.
Rivian's claim to fame is they've built this vehicle skateboard platform, as they call it. And you can think of it as the wheels in the power plant, and they can drop different bodies onto it, different frames. And so they can put on the pickup truck, which is their signature vehicle. I think it's the R1T or something that's supposed to come out next year for production and sale. And they can put a van on it, as they're doing for this Amazon project. They can do SUVs. And so they can do the higher selling products that people want right now. Question is, as always, what's it going to cost? And then what does it take to keep it going? Now, because it's a truck-like vehicle, it can take more of the batteries. And so it can go longer, right? By necessity, it's going to have more batteries. And so it has a longer range to it. So it might get rid of some range anxiety, but you still got to charge it. And so this is going to be the thing. They have 100,000 vehicles. They're going to build charging stations. That's the very first question is, where are all these Amazon vans going to charge? Somebody's going to get business for charging stations for 100,000 vehicles.
Well, what about Whole Foods?
Well, it could be, right? And so there's some other add-ons that make this very interesting, and Whole Foods is a good one. But then you have electricity draw. If you're putting all of these vehicles into the system, then you're starting to pull some pretty good electricity wherever they're located. And so there's a bunch of knock-on things that happen here that we have to think about. If Amazon wants to do it, God love them, it's a great thing. I think the more we diversify our energy use, the better off we are, because we're not locked into just one thing.
Yeah.
But I don't think any one particular approach is a panacea that's going to take over it all. Imagine if we all turn to electrical vehicles tomorrow. It might sound great, but you would not have power in your home for air conditioning at that point because you couldn't. So
Well,
you have to
we
look
need
at all
that.
the pieces.
Yeah, I think now we need the Amazon Prime nuclear power plant or
Well,
something.
well, and you won't get nuclear, but hey, I live in the capital of energy down here where you're going to have a lot of natural gas demand, and that's a good thing. So there's a lot to this, and as I wrote in the economy and markets piece, part of it is with pickup trucks and SUVs in particular. If you see the major manufacturers move to that, they're replacing the sale of their current combustion engine pickup trucks and SUVs, which are wildly profitable. And the profit margin isn't there on electric vehicles. And so if there's a wholesale move to that, watch out because the profitability of Ford and GM could drop dramatically.
Yeah, absolutely. And as we mentioned here on this show, Ford essentially has abandoned building sedans or selling them in the United States altogether.
Yep.
They just become an SUV and truck company. So thanks for that, Rodney. Definitely something to keep an eye on. I'm in love with the concept of this SUV and truck. So I do hope this one succeeds, and maybe building a little bit of competition, especially as Tesla's had its numerous problems. Rodney, looking ahead to next week, we're going to have new home sales release. We're going to get a durable goods release, and we're going to get the U.S. home price index. You have your eye on anything else?
There's not a lot going on. We had the central banks over the last week with the ECB, the Bank of Japan, and of course the Fed with their different announcements, and of course the Bank of England. As we get closer to October, it's going to be a Brexit story as people try to figure out what's going on there, and the EU takes a hard stance, Ireland takes a hard stance, Britain takes a hard stance, and they all trying to figure it out. And in the background, you've got oil. I mean, the attack on the Saudi facilities last weekend was dramatic. It showed a weakness that other people could do, and it puts Iran in the crosshairs. So I don't know what that response looks like, but if there is some physical response to Iran next week, which is possible, that could really cast a pall on the markets where people go, hey, wait a second, we're near all-time highs in U.S. equities. Let's just take a step back and wait through this and see what happens with the whole European situation and the Middle East situation before we take a dive and make a move to higher levels.
Absolutely, Rodney. Thank you very much. And I'd love to hear what all of you that are watching think. Send in your market comments or questions to tv@economyandmarkets.com. For Rodney Johnson, I'm Dave Okenquist, and this has been Economy and Markets TV.